Welcome to StokTok's deep dive into Cloudflare. Cloudflare is a web infrastructure and security company that provides edge computing services, protecting websites from cyber threats while improving performance and speed globally. As of May 5th, the stock is trading at $244. The stock has moved up 18% over the trailing year, reflected in a price range between $120 and $260. The technical setup shows the stock trading above both its 50-day and 200-day moving averages, suggesting sustained momentum. The Relative Strength Index, a momentum oscillator measured on a scale of 0 to 100, sits at 69, indicating neutral conditions. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Cloudflare operates a global network of data centers that intercept and optimize internet traffic before it reaches its destination. The company's primary revenue comes from subscriptions to security and performance services targeted at enterprises and application developers. The business model rests on high switching costs. Once a company integrates Cloudflare services into its infrastructure, migration becomes expensive and disruptive. The StokTok score is 57 out of 100, a hold rating. Across the 5 dimensions, valuation scores 10 out of 20, indicating stretched pricing. Financial health scores 14 out of 20, moderate strength. Profitability scores 5 out of 20, reflecting ongoing losses. Growth scores 20 out of 20, demonstrating robust expansion. Smart money scores 8 out of 20, signaling weak institutional conviction. Now, valuation. The question every investor has to answer: are you paying the right price? Cloudflare does not have a trailing 12-month P/E ratio because the company is not currently profitable on a net income basis. However, the forward P/E ratio, the price divided by next year's projected earnings, sits at 212. This is substantially elevated. The P/E ratio, which adjusts the P/E for expected earnings growth, returns 0, reflecting the company's current unprofitability and making traditional growth-adjusted valuation metrics less reliable. The enterprise value to EBITDA multiple, that is, total market value relative to operating cash generation before financing and taxes, stands at 869 times. This is extraordinarily stretched and reflects the market pricing in exceptional long-term growth and profitability expansion. The price-to-sales ratio, comparing market value to annual revenue, is 42 times. Peers in the infrastructure and security software space, companies like Fastly or other edge computing platforms, typically trade between 5 and 15 times sales. In our view, this valuation implies Cloudflare will need to sustain very aggressive growth and achieve significant margin expansion to justify current pricing. Our DCF model, which projects future cash flows and discounts them to present value, suggests the stock is trading at an approximate fair value with minimal margin of safety. Wall Street analysts, based on consensus from 31 coverage analysts, have a mean price target of $232, with a high target of $300 and a low target of $135. This suggests meaningful analyst disagreement on intrinsic value. Now, let's examine the most recent earnings. In Q2 2025, Cloudflare reported earnings per share of 0.16, which matched analyst estimates. Revenue came in at $610 million, which exceeded the estimate. The year-over-year revenue growth was 9.3%. However, the company reported an operating loss of $50 million and a net loss of $10 million. The business segments showed mixed momentum. Core security products performed well, but the company is still investing heavily in infrastructure and product development. The market's after-hours reaction was muted, with the stock gaining just 0.2% after the print. Market sentiment around Cloudflare, in our view, leans neutral, reflecting tension between strong growth and persistent unprofitability. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point financial health checklist that examines profitability, leverage, and operational efficiency, comes in at 4 out of 9. This suggests material accounting quality concerns and operational stress. A score above 6 is generally considered healthy. The Altman Z score, a bankruptcy risk model that weighs profitability, leverage, liquidity, and solvency, returns 10.57. This is well above the safe threshold of 2.99, indicating low near-term bankruptcy risk despite current losses. The company maintains a cash-to-debt ratio of 1.17, meaning liquid cash covers 117% of total debt. This is respectable and provides a cushion against near-term refinancing pressure. However, interest coverage, the ability to service debt from operating earnings, is zero because the company is currently unprofitable on an operating basis. This is a critical weakness. A company generating negative operating income cannot service debt from operations and must rely on cash reserves. The current ratio, which measures short-term liquidity by comparing current assets to current liabilities, is 1.98. This indicates the company can cover 2 years of near-term obligations with current assets, a relatively strong position. The debt-to-equity ratio, total debt relative to shareholder equity, stands at 2.41, indicating the company carries meaningful leverage relative to equity. This is moderate to elevated leverage and constrains financial flexibility. In summary, Cloudflare has adequate near-term liquidity and low bankruptcy risk, but the combination of unprofitability, zero interest coverage, and moderate to elevated leverage presents a constraint on financial flexibility. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, the profit generated on every dollar of capital deployed in the business, is negative 8.59%. This means the company is destroying shareholder value on a return basis, burning capital rather than compounding it efficiently. This is a major red flag and reflects the company's unprofitability and negative operating margins. Gross margin, the profit after direct cost of revenue, is 74.51%. This is excellent and reflects strong pricing power and product-market fit on the core offerings. The company retains 75 cents of every dollar of revenue after paying direct costs. Operating margin, the profit after all operating expenses including sales, marketing, and research, is negative 9.56%. This is deeply negative and reflects that the company spends more on operations than it generates in gross profit. Net margin, the bottom line profit after all expenses and taxes, is negative 4.72%. This means the company is losing roughly 5 cents on every dollar of revenue. In Q2 2025, the company reported these losses, highlighting that despite strong gross margins, operating leverage has not yet expanded. Free cash flow margin, the cash available to investors after maintaining and growing the asset base, is positive at 12.2%. This is a critical data point. Despite accounting losses, the company is generating positive free cash flow of roughly 12 cents per revenue dollar, primarily due to working capital management and lower cash operating expenses relative to accrual-based charges like depreciation. This suggests the path to profitability may accelerate if management focuses on cost discipline. The disconnect between negative net income and positive free cash flow is important. It reflects that Cloudflare is currently investing in growth and infrastructure, but the underlying cash generation is healthy. Onto growth. Is this business expanding and at what rate? Cloudflare has delivered exceptional revenue growth. Over the trailing 3 years, revenue has grown at a compound rate of 30.5% annually. Over the trailing 5 years, the compound growth rate is 33.5%. This puts the company among the fastest-growing software infrastructure platforms. The most recent quarter showed a 9.3% year-over-year revenue increase, which represents a marked deceleration from historical rates. This is a critical observation. When a hyper-growth company enters the mid-20s revenue scale, hundreds of millions moving toward billions, growth naturally moderates. However, a slowdown from 30+% to 9% in a single quarter suggests either market saturation headwinds, increased competition, or a shift in customer demand. Management's guidance on this deceleration and forward expectations will be crucial. Book value growth, which reflects the equity accumulated in the business, has expanded at 29.9% over 3 years. This is solid and reflects that retained earnings and capital investments are building shareholder equity, even as net income remains negative. The company does not pay a dividend, which is standard for growth-stage software companies that reinvest all cash into product and market expansion. In our view, the growth profile remains attractive in absolute terms, but the recent deceleration warrants close monitoring on forward guidance. The market consensus for next quarter reported earnings are estimated at 23 cents to 28 cents per share, which would represent a meaningful sequential and year-over-year earnings improvement if achieved. Now let's talk smart money. What institutional capital is actually doing with this name? 13 top-tier institutional investors and family offices, tracked by institutional research firms, currently hold Cloudflare. Among all hedge fund and mutual fund managers filing Form 13F with the SEC, only 6.8% are currently net buyers, meaning they own more shares than they have sold in recent periods. This is below the 50% threshold that would indicate broad institutional enthusiasm. The data suggests that, while some sophisticated capital is long the name, the majority of tracked institutions are either flat or sellers. Insider ownership is very low at 0.54%. This is concerning because it signals that company management and employees have minimal personal capital at stake in the business. Over the last 3 months, there have been 0 insider buy transactions and 22 insider sell transactions. This is a red flag. Insiders who believe in the business tend to buy their own stock. The absence of insider buying, combined with aggressive selling, suggests limited confidence in near-term value creation by those closest to the business. The contrast between the broader institutional picture and insider activity is stark. 13 guru-level institutions are long, but management is selling. This divergence is worth noting. It may reflect different time horizons. Institutions may be playing a multi-year growth thesis, while insiders are simply rebalancing compensation. However, as portfolio managers, we flag insider selling as a cautionary signal and view it as less than fully supportive of a bullish thesis. And finally, the verdict. Let's bring it all together. On valuation, the forward PE of 212 and price-to-sales of 42 are stretched relative to historical peers and offer minimal margin of safety. On financial strength, the balance sheet is adequate with positive liquidity and low bankruptcy risk, but unprofitability and elevated leverage constrain flexibility. On profitability, the business suffers from negative returns on capital and negative operating margins, though strong gross margins and positive free cash flow suggest a path forward if the company achieves cost discipline. On growth, the company has delivered exceptional trailing growth of 30 to 33%, but the recent quarterly deceleration to 9% warrants attention and bears monitoring on forward guidance. On smart money, institutional enthusiasm is mixed, and insider selling is notably aggressive, suggesting limited confidence by those closest to the business. On recent earnings, Q2 2025 showed a revenue beat but operating losses persisted, with the stock reacting minimally, reflecting market skepticism on profitability timing. In our view, Cloudflare presents a classic high-growth, low profitability setup. The company has built a legitimate franchise with strong switching costs and a proven product-market fit. However, the valuation offers limited downside protection, and the path to sustained profitability remains uncertain. The deceleration in growth and aggressive insider selling are yellow flags. The thesis works if management demonstrates material margin expansion and re-accelerates growth, but those catalysts have not yet arrived. We would characterize this as a hold. The risk-reward does not yet favor aggressive buyers at current prices, though longer-term holders have optionality on execution. Everything in this video is our interpretation of publicly available data and is not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Cloudflare. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data, that affects the stock becomes available.